over the inventory basics here for a second. This is all in chapter 5. And I'll let's see, let me take just a moment and let me take a moment and walk through this. So you're going to figure out, you're going to walk through the inventory basics, determining what's in inventory, how to the cost associated with it, how to control it, and then what is typically done as a physical count. Sometimes on an annual basis for some companies. That's why you'll see, like, if you walk into a variety of large businesses, you'll see, like, inventory control type things around December. Typically, they may even do it throughout the year, and you'll see these kind of markings from time to time. You'll wonder, well, what are they doing? Well, this is what they're doing. They're counting the actual inventory at that particular time and verifying it against what's on their records. Because you could have theft, you could have damaged material that hasn't been recorded correctly. So you have a lot of different things you have to make sure you account for periodically. And then it'll take you into these costing methodologies. I've mentioned first in, first out, FIFO, last in, first out, LIFO. Yeah, LIFO. Somehow, for some reason, that didn't seem right to me, but it is. And then weighted average, and then specific identification. You'll go through each of these 4 different costing methods, and then some reporting and analysis based on it. Right. So let me see if I can. For most of this, they talked about damaged and obsolete goods, the internal controls for taking physical count. These are going to be very helpful to walk through in a very methodical method, right? These videos that help you walk through that. This is where they start to get into how things come in and come out. And you want to think of this in terms of, oftentimes why they use this is because, like, for example, goods that are likely to spoil quickly, they may want to, like when you go to the store, the oldest milk is up front and the oldest milk is in the back, right? So you want that first in, first out type of an approach, because you want that the milk to be sold before it's expired. So if you think of it that way, it comes in, it just kind of racks up and it's gone. The oldest stuff is gone before the newest stuff. On the opposite curve, you might have a last in, first out type of a scenario where it comes in last and it just goes. Now, why do you do that? It's more of an inventory method, but you might do that for things that are more susceptible to inflation, and they want to get the items that are newer, that maybe cost more, to be sold first, because those items, at least on the balance sheet, are going to generate the lowest net income. And sometimes you want that, sometimes you don't. It just kind of depends on the business methodology on that. On weighted average, maybe the price fluctuates so much that you just want to average it out. And so that's why they're going to go with the weighted average type of an approach. And so each of these different approaches will show you in a visual standpoint how it works, okay, and what the differences are, both the gross profit as well as the inventory balance value. You'll want to make sure you understand this formula in general, where you take the beginning inventory plus any net purchases. That's what's available for sale. And then effectively, inventory equals the ending, merchandise available for sale, ending inventory plus cost of goods. So this sometimes a little confusing. So, but you have to go through the logic here a little bit. Let me see if I can find my Excel spreadsheet here a little bit and just walk you through this. So if you think about your inventory account, right, you're going to have some debits and some credits. Well, typically you're going to have a beginning balance, okay, and it's a debit because it's an asset. So let's say it's a 1,000, right? You're going to purchase some items, and let's say you purchase 500, right? You're then going to sell some items, right? And that's going to be a credit. Let's say it's 250, and then you're going to have an ending balance, right? So the ending balance, if I just put a little deal there, it's going to end up being the sum of your debits minus the sum of your credits, right? And so your balance is going to be 1,250. Well, if you know the other side of this coin, let's say it's accounts payable because you buy the stuff on credit, okay? So this entry, when you purchase it, usually comes over here as a credit, right? When you sell it, then the entry is usually going to go to your cost of goods, right? So this credit right here ends up being a debit over here on the cost of goods. So when they talk about this, let me see if I can close this up a little bit or make it smaller. Oops, not that small. That's not what I wanted. Oh my goodness gracious. Okay, so I meant to do this. There we go. So when you're looking at this formula, you can see this beginning plus net minus the sale, right? Beginning plus net minus the sale. But then you have your ending inventory plus your cost of goods sold is another way of looking at that, right? So ending inventory plus cost of goods sold was the merchandise available for sale. So depending on what you get in your problems, you might like get beginning inventory, ending inventory plus cost of goods sold, and you need to figure out net purchases, right? So you might have to end up adding ending inventory plus cost of goods sold to get your merchandise available, subtract out the beginning inventory to figure out your net purchases, right? So there's this is the A plus B equals C type of formula approach, and you want to make sure you understand this. And this is a way to view it slightly different, right? In a journal entry type of approach or a T-count approach. Okay, to walk you through the inventory costing illustration, right? So they're going to walk you through how these transactions look as far as inventory. So you're keeping track of both units as well as dollars, right? Goods available for sale, units available for sale, minus what was sold, and it gives you what's left over in a period of time. Now, this is just the generic approach, okay? Then they walk you through, well, what is specific identification? And it's usually specific identification is used for goods that are large, typically, or where they have a unique identifier. For example, let's take in this case, they're taking bikes, right? You might buy a couple of bikes of one type, a couple of bikes of another type. They may have a very specific identifier. And so when you sell them, you're going to take it out of inventory for the cost of that specific item. Now they use bikes as an example. I tend to think of this as like cars, right? Or trucks, or big pieces of equipment that cost a lot of money that have a serial number behind them. So typically I'll do it that way, or you might find these in batches of materials. So let's say it's a batch of, I don't know, items that cost a very specific number, but they're usually bigger dollar values. They're talking about a bike costing $100 each. I'm not sure if bikes cost $100 anymore or not, but the reality is that they're probably like $500 at a minimum to $2,000, and so I can understand maybe that type of approach. And so they'll walk you through, well, how does that come in and out of inventory, right? On the first in, first out, we already talked about the milk, but they continue on the bike analogy. And what was bought first gets sold first. Okay, and they'll walk you through that scenario. Last in, first out, same thing. Okay. And then they'll walk you through a weighted average type of an approach. Now, one thing to note, I don't think that's here yet. I'll find where it comes up. This is the impacts, so no problem. There's slightly different impacts, and then they'll walk you through a couple different scenarios on using the specific identification, first in, first out, last in, first out, and weighted average. Okay, so very important to walk through this and how it works out. Now, I know some students think that the textbook isn't very helpful in learning this stuff, and I disagree wholeheartedly. You should be able to walk through this example, okay, on the video and in text form, and it'll match almost nearly exactly what you're going to see on the quiz access and the quiz itself, and in fact, even the exam. So if you understand this material by walking through this video, okay, you should, like when you do the quiz access, be able to pull this up, right? This very specific thing that shows you, we purchased however many and what does it look like? In terms of specific, periodic, LIFO, and weighted average, and actually see the transactions and be able to do the work side by side. Okay, you can even come back up to some of these examples and see it side by side. So this is going to be very helpful for you, especially on the quiz access, be able to look side by side and be able to understand how it flows, right? Lower cost of market, that's lower of cost or market. Doesn't get tested much, but you'll have to still understand it because the concepts of it will come up. Here's your beginning plus net minus ending, and equals cost of goods sold formula. Very important to make sure you're aware of. And this will be tested as well. Impacts if things aren't done correctly, right? Overstated, understated, what happens in the overall equation. All right, they show you how things move from 1 year to another. There's lots of questions, usually semester to semester, on this area, as well as the balance sheet effects, right? So what happens if you understate inventory 1 year, right? This gets tested regularly, these types of scenarios. So make sure you're familiar with them as well and understand why. And then we go through a couple of inventory analyses, ratios, and turnover. These are definitely important to remember. Okay, they're going to be similar to this, the AR turnover, and the sales turnover calculations that we did before. This is going to be specific to inventory. Slightly different calculation. I think that's it. The only other thing I wanted to cover that I keep, let's see if I can find it, is the difference between periodic and perpetual. Let's see where we find that. Inventory basics. It's important to note that really, in my mind, the only difference between periodic and perpetual is the slice of time. Perpetual means that you're looking at it every time you do a transaction, right? You're looking at the past in terms of what's been purchased and what's left in inventory. And so let me see if I can find where they talk about this. Periodic inventory system, right? They start talking about it here versus a perpetual system. So periodic means that you'll look at the inventory, let's say that all the transactions that have happened within a month, and then you start to do, okay, well, what came in, what came out, either in a FIFO, LIFO type of situation. Or you might do it every quarter, or you might do it every year, right? Look at all the transactions, the ins and the outs, and do the evaluation then. That's periodic. Whereas, and that's what it says right here, right? Updated at the end of each period, and typically monthly, but sometimes quarterly or annually. Perpetual, right? Does it show it here? Let's see if we can find perpetual in here. Perpetual. There we go. There's some systems that use the perpetual system, which really is just a much shorter view of that. It's really daily, right? So every transaction that comes in and out, they're looking at what's the prior balance, what payment, what has been added to inventory, and what needs to be subtracted from inventory, and evaluating it at a very, very small granular situation. This is not covered as much as periodic, but it does need to be understood. So most of it is in this periodic method, right? You're looking at a month's worth of transactions and figuring out what happens, the ins and the outs, evaluating things. Periodic, C5A talks about the perpetual. So it's a concept you need to understand the difference between perpetual and periodic, but for the most part, you're going to be tested on periodic. All right. So with that, I don't know if there's anything else I can provide in terms of insights into what's coming up this week. If you have any questions, please let me know, and we'll walk through it definitely on office hours during the week, but I can also just answer the questions as they come up throughout. Have a great one. Take care. Enjoy.